टैक्स से मत डरो, एच&आर ब्लॉग को सब्सक्राइब करो।
What is the first thing that you want to do as soon as you receive your salary? Party? Buy something fancy? Wrong. We all have heard that the mutual funds are subject to market risk, but it doesn't have to be if you have a long game planned smartly. This is where SIP comes in, where you can invest in different types of mutual funds according to your financial needs and long-term goals. In this video, I will be explaining what is SIP and how to invest in mutual funds smartly. So, let's get started. Disciplined approach. One of the most amazing features of SIP is that you can choose the amount of money you want to invest, which can be as low as Rs 500 per month. The amount you choose to invest will be automatically deducted from your account periodically and will help you to build financial discipline. So now you can spend your money as your wish without feeling guilty about not saving. No need to time the market. The market can be like a roller coaster ride where it crashes and soars high without a warning, which leaves the investor feeling giddy. With SIP, you don't have to worry about any of the ups and downs because you will be investing regardless of the nature of the market. Over a span of time, it won't affect your profitability. Now, this brings us to another great feature of SIP. Rupee cost averaging. Oh snap! Technical term alert. Don't worry, it's a very simple concept to understand. As mentioned before, your investments are consistent irrespective of the nature of market. When the market is low, you will get more stocks, and when it is high, you will get fewer. Over a span of time, the cost of stock will average out and you will receive a handsome profit despite a volatile market. Power of compounding. The beauty of investing in a tool like SIP is that the profit you make every month is compounded. So simply put, if you invest 100 in the first month and you earn an interest of 10 on it, the amount you get is 110. And in the next month, the amount would be calculated on the addition of previous 110 and current 100, which makes it 210. Now again, with the interest of 10%, the amount you get will be 231. This process goes on till you take out your money. And to now calculate your investment, you can refer to the compound interest formula that was taught to us during our school days. And for those who didn't pay attention in the class, here is the formula. Affordability. It's a myth that investments are luxury for the rich. With the investment option of as low as Rs 500 per month, you can opt for SIP without worrying about any financial strain. Now, you can even choose to discontinue your plan at any time without any obligations or fixed lock-in period. Convenience. The vast reach and endless possibilities of SIP makes it unique for everyone. You have a complete control of your future. Variables such as how much to invest, where to invest, and durations are all decided by you to cater your financial needs, limitations, and your goals. Tax saving. If you still find investing in SIP is not very lucrative, then it has another outstanding perk which every taxpayer will love. If you choose SIP in ELSS scheme, then it is applicable for tax saving under Section 80C of Income Tax Act. So now you are not only making money by investing, but you can also reduce your tax liability. Well, to understand ELSS and its benefits, check out our guide, where you can find the difference between SIP and lump sum. Find the link in the description. So, what are you waiting for? Start investing right now. Like this video and do everyone you know a favor by sharing it with them. Subscribe to H&R Blog India by clicking the red button below to get information about personal finance, GST, and saving taxes. Check out these videos as well. And when in doubt, always remember, tax se mat daro, H&R Blog ke saath chalo.